before we actually start?
You didn't like my intro music?
I couldn't tell what it was.
It was Drink in My Hand by Eric Church. It's literally a song about getting off work on Friday, enjoying the labors of the week behind you.
Who's this Ashley Alexander chick making these snide comments about whatever?
That's the third employee ever in TMC history. 4-year anniversary for Ashley recently. So
Oh, very good.
as I joke with her now, it was a leap of faith at that point to join TMC. We're a somewhat legitimate organization now. So, but you know me, I appreciate the people that were on board with TMC in the early days when it was not as tightly formed as it is currently.
Do you have a ESOP and a profit sharing plan?
No, we have a 401k now.
Well, that's good.
Yeah. So baby steps. So
There you go.
well, happy Friday afternoon, everyone. I'm Rich Swerbinsky with the Mortgage Collaborative here with the rundown with Rob and Rich. Our Friday afternoon take you into the weekend recap of all things mortgage industry. And as I am every Friday at 3 Eastern, joined by the esteemed Rob Grisman. Rob, good to see you.
Hey there.
Nice job adding to the background set with what is that? The Raven from Edgar Allan Poe to go with the spider this week.
Quote the Raven, nevermore. The spiders moved from last week.
It did. Yeah. Like a different angle or something. Always keeping us on our toes, Rob, but always good to see you. And just you and I this week. So we're going to have to talk more. So let's get after it. MBA annual starts this weekend out in San Diego. Anything in particular you are there to see, hear, curious about?
Yeah, I think I head to San Diego tomorrow morning. I know some people are heading in today. The Empower event is tomorrow. I'm going to attend part of that. I have some consulting engagements for tomorrow afternoon set, but I think the overall, and I'll go to the capital markets session certainly on Sunday afternoon. The overall feeling, though, as you saw with the TMC event some weeks ago in Southern California, I think people are just anxious to see one another and to, say hi. And there are some very, very good sessions that I plan on sitting in. And of course, there's the TMC Gala Extravaganza at Lou and Mickey's, literally across the street from the convention. But I'd say, despite the sessions and despite the formal parties or the events, I think just walking through the hallways and seeing people that you haven't seen in a year and a half or 2 years is what people are truly looking forward to. So, certainly the sessions will be good and there'll be a lot of information out there, but it's just, I think people are anxious to see one another and be reminded that we're in a really good business with a lot of smart people and a lot of friendly competition, and just exchange pleasantries. So it'll be good. What do you have on tap for the event?
As always, taking stock of, the decisions that lenders are making on emerging tech vendors, just, for our network, and making sure we, have the most relevant third-party providers and are, out in front of any trends or anything that's happening in the mortgage industry. We, always want to be to the party before it gets crowded. So I've got, I think 27 meetings or something crazy, Sunday, Monday, Tuesday, with some incredibly intelligent lender humans. So I walk away from these things, just the amount of institutional knowledge, mortgage banking operations I walk away with is always great. So that in general, data, ways companies are using actionable data in different, unique, creative ways, to me is an interesting trend that we're seeing. And then as always, just I think the loan manufacturing process is in evolution right now, became still so human, and people added so many humans last year. I think in general, lenders are trying to figure that out, right? How can I have a little bit more nimble with the ebbs and the flows of the industry and a little bit less human loan manufacturing process. So yeah, no shortage of things to take stock of next week. So
Yeah, I agree. I don't have as many meetings as you do. I will warn any participants that given given what happened at the last San Diego mortgage conference, it's can be relatively spread out, and just allow yourself. You don't leave one meeting at 11:58 to get to a noon meeting 2 minutes later in this kind of environment. Give yourself 5 or 10 minutes to hoof it to wherever you're supposed to be next. So it can be spread out. So as I mentioned in my commentary the other day, wear stylish but sensible shoes, and be prepared to burn off some calories.
absolutely. And to our attendees, any thoughts you have on MBA annual or anything going on in the mortgage industry, anything you want us to talk about here on the show, please don't hesitate to type it into the chat or the Q&A, and we will incorporate it into the show. Rob, let's get to some of the news headlines, some of the things going on in the industry. And, one thing I'm watching with a lot of intrigue right now is just the infrastructure package. A lot of housing related stuff that was in the first iteration, the 3.5 trillion. We know now that's being just hacked apart to some lesser version that has a better chance of passing. And, just from everything I'm seeing and hearing and reading, really next week is really where the rubber meets the road in terms of all these negotiations on what stays, what goes, and been a lot of speculation out there about some of the things on the housing side that could be gone, that could stay. First time home buyer assistance, which again, with all this demand and no supply, I don't know if I'd be prioritizing that the highest, but then some stuff I would prioritize higher that may stay or may go. Some tax credits and grants for those that either rehab or improve or construct new homes in underserved areas and communities. So your thoughts on the infrastructure package and all the housing related stuff in there?
Yeah, I think that from what I'm hearing from the collective group out there, the lenders are paying attention more now than they have in the past, because things are starting to solidify a little bit. Up until now, or up until it's actually signed, it's all kind of vague and nebulous, and lenders and vendors are saying, well, that's fine for them to jawbone and to posture and to be politicians. And the far left are throwing out things, and the far right are throwing out things, et cetera, et cetera. But now it's starting to solidify. And now lenders are just now starting to your point, some of the items you listed there, they're just now starting to think, all right, what do we do to take advantage of some of the things they're talking about? Or what are we doing now that might be eliminated in the new legislation? So right now, I would say the lenders and vendors are out there saying, all right, how does this impact us? To the points that you raised, what does it mean for us? We're not going to go with some kind of Bernie Sanders or Elizabeth Warren plan, but a more moderate thing, more moderate items with regard to affordable housing and so forth. What kind of programs, what kind of rates do we have? What kind of down payment assistance programs do we have? And when you combine that with the some of the affordable lending initiatives and what's going on with the CFPB and the new director that's been confirmed, at that point, what do we need to do as lenders? Because let's face it, everybody on this call, everybody in our industry knows that we are here to help borrowers get home loans. The question is, how can we best do that? They want to borrow money. They may not have a huge down payment, but maybe they have some, let's hope. And so what can we do? What kind of programs can we roll out, or what do we already have in place with regard to some of the down payment assistance, affordable housing, et cetera. What do we have now that, given what they're talking about, that has solidified a little more to the points that you raised? What do we have now that really are going to give us a leg up on our competition and are going to help borrowers out there? So I think it is interesting. It certainly steps in the right direction, because whether it's stocks or bonds, markets and businesses don't like a lot of uncertainty. That's the big thing. When the market makes a big move, whether it's stocks or bonds, it's typically because of a surprise. You go back to the taper tantrum from several years ago, because it caught the market by surprise. Since then, the Federal Reserve has done their utmost. The presidents are always out speaking, opining, so forth, tapering, they're talking about it in the minutes. I mean, it's going to happen. And so the market, the bond market is much more, that we're used to it now. It would be a surprise if they didn't taper. And so the fact that they will eventually, okay, we get it. We were warned about it. So the market, like I say, stocks or bonds, they don't like surprises. And the fact that the legislation has moved, to where we are now, I think lenders have had adequate time to digest and kind of think about the programs that they want to have in place, what they want their compliance to be looking at, looking at some of the housing finance agency programs that are out there, working with them, so forth. So there's a lot to go on. There's a lot that will happen, but I will say that for the most part, every lender out there still wants to keep helping their borrowers. It's just a matter of how they're going to, adjust possibly to what the government is proposing. What are you hearing among the TMC members? You're knee deep in this every day.
I think a lot of what you just said, like, when there's a little bit more for me to chew on, I'll start to, get under the hood a little bit more on how it can impact the company. Because, right now it's just a bunch of speculative proposals and in a very large bill that may not pass, that's being amended. But one thing I did see out there that was like actionable, like what does it mean for me as a lender, is the part of the infrastructure package related to housing, as noted earlier, the tax credit program for rehab and construction of new homes in underserved areas. This is a White House estimate, so take it for what it is, but it's a $20 billion that is included for it, that they're hopeful will remain in the package, all of it. And the White House projections are that over the course of the next 5 years, it would lead to the construction of 500,000 new homes in underserved areas over the course of the next 5 years. And we brought up the charts, I think it was last week, that showed right now roughly there's 650,000 homes for sale. So it, at least on the surface, seems like something that would move the needle and have impact in an area of housing that we really have some supply issues. So, and to your point about the Fed tapering and just how well they telegraph that, it reminded me of something I read today, actually, where so it was somebody from the Fed, it was today or yesterday, laid out like their plan for taper. I think right now they're buying about 80 billion a month right now of mortgage-backed securities. Some of that is runoff because all the refi that they're just replacing, but that they would taper at a rate of 5 billion a month over 8 months, because 40 million is the true new buys when you take in the fact the runoff that they have. So, but some things to chew on. But yeah, I think once a package is finalized and the bill is approved, then I think you're gonna have lenders very interested.
Yeah, I will. You and I have talked about this quite a bit, and I know you probably want to talk about the Goldman Sachs forecast or the Fannie Mae forecast, but the very things that you and I have been discussing on this show for several weeks now with regard to supply and inventory, and demand. If you look at, I get asked, and I'm sure you get asked, I mean, everyone's saying, oh my gosh, bubble, 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 toil and trouble. Is this going to burst? When's the party going to end? And if you look at the reasons that we've talked about, the demographics, millions of people who are turning 30 every year want to own a home and don't. If you look at the immigration numbers, if you look at the divorce numbers, if you look at people who have spent the better part of 2020 and into 2021 saving money for either down payment or buying a house with cash. If you look at the demand versus the supply, I don't know, you mentioned several 100,000 homes that are listed now. There are more realtors than there are listings that are out there. You look at builders who are building, 1.5 million or 2 million houses a year. The supply and the demand, they just don't jive. Certainly with the interest rates where they are, housing is more affordable, I think, than renting in many markets. And when you talk about a bubble, and when people on the phone have clients who may be worried about a bubble, it's important to remember that if there's a jarring impact to something, and people often talk about interest rates, interest rates are going to skyrocket because the Fed's going to stop buying mortgage-backed securities, and that means mortgage-backed security prices will drop, which drives the rates up. And oh my gosh, rates are going to go to 5, 8, 10%. Well, they're not going to go that high. I guarantee it in the foreseeable future. So their talk of tapering is very good. It's very soothing to the market. It's very soothing to mortgage-backed security investors, because mortgage-backed securities are still a great investment. They have a decent return. Much of it is backed by the U.S. government, backed by great underwriting guidelines. The borrowers who are obtaining financing now are arguably the best from a credit perspective, best in history. I mean, there's a lot of reasons why we are where we are, and the system isn't going to get shocked. So I just don't. And to your point, the government coming in and saying, okay, well, we want to do this, we want to do that. Between you, me, and just between us girls, shall we say, I get a little nervous when the government comes in and has certain objectives, because I remember back when we had a government objective in terms of home ownership, and everybody on this call and basically everybody in the industry will tell you that we're never going to reach 100% home ownership. Some people don't want to own a home. Others can't afford it and shouldn't own a home. They can't afford it from a credit perspective. Whatever it is, we're not going to get 100% home ownership. So when the government puts out certain proposals with regard to affordable housing, hey, that's great. But I don't want affordable housing units going up in my backyard, not in my backyard. So it'll be interesting to see how that information gets down to the grassroots, gets down to the builders, what kind of motivation communities have to build affordable housings to meet the government's goals for that kind of stuff. So lots of stuff going on out there for us as an industry. It's actually pretty neat. It gives us something to talk about, right?
It's the famous Reagan line. The most terrifying words in the world are, "I'm from the government and I'm here to help." I think that was the one. So that said, with Federal Reserve, obviously has I think done a really good job just with rate policy and keeping interest rates low and all that comes along with that. I agree with you. I think even when they taper at a level of taper off at a level of 5 billion in MBS purchases a month, it's going to have almost no impact, in my opinion, none. For all the reasons you mentioned, I think private money will come in and replace that, and they're going to do it systematically and it'll be handled orderly. But different ball of wax when you're talking about policies related to home ownership and home ownership levels, and it's just completely different. And you mentioned it a little bit ago, the Goldman report that came out a couple of days ago. Goldman Sachs came out with their projection for 2022, as did Fannie today. We'll get into that as well. Goldman Sachs projecting 16% home appreciation levels in 2022, which mirrors exactly what you and I have been saying.
And frankly, Rich, I'm tired of Goldman Sachs copying. I'm sure Goldman Sachs has a representative on this call, and I'm tired of them, parroting you and me. But anyway, go ahead.
Exactly right. But I just, I can't see any scenario other than, and Fannie Mae came out today with their projection for 2022, and you're going to see all the others do the same soon here. Freddie, MBA, and CoreLogic, and all the big economists. But Fannie projected 7.4% home appreciation next year, and projected an average 30-year fixed rate throughout the course of the year, like slowly going up to 3.3% on the 30-year fixed, which I'm in line with that. I think that's roughly what you'll see, barring something completely unforeseen. But so yeah, you're starting to see the projections come in, and but the Goldman report caught a lot of people's eyes because I'm on Reddit a lot, but there's constantly people on Reddit in the financial forums that are predicting, like a complete housing crash. And all these people on there, oh, I can't wait till values plummet, so I can scoop up a house, and I'm on the sideline. I'm sitting there thinking, these dumbasses are just going to keep watching home prices go up and up and up because there is way more demand than supply. And that is simple, good old US American economics.
Right. And people say, well, look what happened in 2008, 2009, 2010. And not at the risk of talking about what I mentioned earlier, the borrowers now, when you talk to loan officers, and I met a loan officer a couple hours ago that I correspond with quite a bit. We got together and had a snack, and she was telling me that her borrowers now are better borrowers than she's ever seen from a credit perspective. The borrowers now, the housing stock is in much better shape from a owner perspective than it was 13 years ago, when we had the stated income, stated asset, and the ability to repay wasn't in place. And I remember when ability to repay ATR requirements were being put into place, and I think a lot of people in the industry understood why ability to repay had to be or should be input, because it gives secondary marketing investors comfort that the borrowers are going to repay the loans, and that's a huge thing. So, but there was a fair amount of grumbling. Oh my gosh, ability to repay, grumble, and now it's just kind of accepted. And there are companies out there that might be pushing the boundaries a little bit, because there is some subjectivity with that. But nonetheless, I just don't see, as I said earlier, the demographics don't point to any kind of bubble. The credit quality doesn't point to any kind of catastrophic plummeting. To your point, somebody waiting for values to plummet so they can buy. There's a lot of people with a lot of money out there. Maybe not you, maybe not me, but there are a lot of other people who have a lot of money and who are perfectly happy to buy another house or two or three and rent them out because they've got the cash. And whether or not they get loans, we'll see. But there's demand out there, and the U.S. population is continuing to grow, and people still want to live in desirable areas. And at certain price points, there's almost no inventory in some areas. So yeah, I think it's a great time to be a lender, and a great time to be working with the borrowers that we as an industry are working with.
Absolutely. Another interesting report that came out I think yesterday or today from Zillow, just demographic trends on home buyers, and some very interesting trends. And the main one is baby boomers are millennials. The percentage of home buyers that are baby boomers is just going up and up and up each month. The percentage of home buyers that is millennials is going down and down and down each month. Not to stereotype, but that group that is saying, "Oh, I'm going to wait it out," and would tend to be more the millennial group, and the group that would say, "I like that house and I'm going to buy it because I'm older and smarter and I think values are going to continue to go up." That would generally be the baby boomers, and but just very interesting statistics on how baby boomers are just kind of kicking the millennials' asses on all these home bids and home bidding wars. So
Yeah, I think that they, when you look at the age differences, I think that there are certain generations that are more willing to use some of the tools that are out there. So if you go to the Wayback Machine, my mom and dad, the first house that they bought was in 1967, and my dad got a VA loan at 6%, and they paid it off 30 years later. There was none of this refinancing garbage. My mom would drive the check down to the bank every first of every month, kind of thing. Things have changed, and now, for example, I know MGIC has a HFA event coming up, a roundtable on the 20th, where they're going to talk about these programs that, as you point out, certain generations are more prone to use, and therefore demand housing, or come in with a different way of looking at bidding, the bidding process. It's just kind of the landscape has changed, and we as an industry, I think, we're like cutting edge. So we're seeing all this happen. It's not like we're building faucets, kitchen sink faucets. I guess there's an evolution of kitchen sinks now. You can buy a faucet and wave your hand over it, and the water will come out, which is pretty cool. But there are some industries where there's not a lot of change, and the fact that we are part of this, and we're once again helping borrowers take advantage of some of these things, whether or not they're in their 20s or 30s or 40s. It's certainly interesting watching. It'll be interesting to see what happens with the older baby boomers who are aging in place, not wanting to sell their houses. Some of them are moving to assisted care facilities or retirement communities where you can play canasta every afternoon if you want to. I'm probably about a year away from doing that myself, but it's fascinating watching some of these things take place out there, and we're a part of it. So very cool.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Chrisman. Just a couple minutes left. We're going to keep it a little bit more abbreviated this Friday. But Rob, I didn't realize the minimum age for a millennial now is 25. Like, to talk about time flying. I still call my kids who are 16 and 13 millennials, and they're not even close. The millennials are people currently aged 25 to 40, Gen X 41 to 56, baby boomers 57 to 75. I hadn't looked that up in a while. It surprised me for some reason. So
yeah, I don't. I'm hesitant about labeling generations. I think that there's a fellow, Landon Jones, who was the editor of People magazine back in the 1970s, and he labeled the baby boom generation. And then now we tend to label different generations, and different generations have different time scales. Baby boomers, I think, from the late 40s into the early 60s. I don't know, but anyway, they're aging, and I saw a statistic that said there are 5 million people in the United States who every year turn 30 right now. Okay, so that's 5 million people turning 30. And once again, getting back to the demographics, if builders are building 1.5 million or 2 million houses a year, and you've got 5 million people turning 30, there's a discrepancy there. So,
and we can't leave, I got to always at least take one jab at United Wholesale in every show. Your boy, Matt Ishbia, walking back the cryptocurrency payment thing. He consult you on that?
Matt, Matt would laugh if he heard you call him my boy. He and I did, we did email a little bit yesterday when that news came out, because there was some confusion there and people were asking me, and I thought, well, I'm just going to ask Matt. So, I mean, we have a decent relationship. He's a very competitive guy, but I will tell you, I'm not a fan of cryptocurrency. Maybe I'm old fashioned. When I go to the bank, I actually go in the bank. I get a supply of $2 bills whenever I go, so I can use those and for tips and so forth. But anyway, that aside, cryptocurrency is this vague kind of thing, and I think that United Wholesale realized that, gosh, if you've got something that's going up, 5 or 10% in a day or in a week, how are we going to see the stability that we need in order to transact in real estate? Because title companies and lenders, I mean, the part of this whole thing, part of the whole title process and part of underwriting, everything points to stability and making sure the borrowers can repay the loan, and making sure they've got good credit, and making sure this and making sure that, making sure that they have the funds to buy this house, to put down a down payment. And so if it's fluctuating wildly, and there's a huge argument about cryptocurrency just being there for speculators, and I don't want to get a bunch of comments in the chat room about the pros and cons of cryptocurrency, but I think, to their credit, United Wholesale said, you know what, we tried it, didn't work, so we're out. So good for them. I don't blame them. You'll notice that a lot of companies didn't follow their lead and say, oh yeah, we're going to do that too. I think there's a lot of hesitation in the industry about cryptocurrency, whether it's Bitcoins or whatever. And, is that the stability that we need as an industry in order to transact in real estate and to borrow money? So, hats off to them for saying, all right, we're done, and not, doing some other things that people do when they make mistakes or realize that they were wrong. So, they're pretty public about it.
I'd ask about weekend plans, but I know we're both heading to San Diego in the morning. So looking forward to seeing you out there and seeing a bunch of people that I have not seen for a while. To your point at the beginning of the show, yeah, just a lot of love. If you just think about what the hell has happened in the mortgage industry since the last MBA conference, I mean, it's been like, even in this crazy industry, the last 18 months have been, we'll be talking about it the same way we bring up 07, 08 on this show, pretty much every show. We'll be talking about this for a lot of years. It's been surreal.
And we were in a great place as an industry to participate and help people. So it's a good thing.
Absolutely.
I mean, COVID isn't good. Nobody wants a pandemic, but we did a great job.
I completely agree. And we're a huge part of the stability throughout the whole country. And it was a good time in many ways for our industry. And it'll be good to get back to the old times and see a bunch of old friends these next several days out in San Diego. So to all of our attendees, thank you so much for wrapping up the week with us. We are here every Friday at 3 p.m. Eastern with The Rundown with Rob and Rich. And until next Friday, we will see you
probably next Friday, Rich, you and I will be talking about our takeaways from the conference. So that'll be a good episode.
Yeah, no, I'm looking forward to that, and we will definitely do that. So thanks again, everyone. Have a great weekend and next week, and looking forward to seeing many of you. And we'll see you here on The Rundown at this time next week. Take care.